You know what nobody tells you about being broke? It costs more than being comfortable. Not just emotionally, not just mentally, literally, in actual dollars, every single month. And that is not a motivational line, that is math. And today, you are going to see exactly how that math works against you. And more importantly, how you start reversing it. Here is what is actually happening. Most people think being broke is just a money problem, like you simply have less, so you spend less. Simple equation, right? Wrong. The real hidden trap is this. Being broke forces you into decisions that cost you more money every single day just to survive, and those extra costs make it harder to escape, which keeps you broke, which keeps the costs high. It is a loop. And if nobody ever points it out to you, you can stay in it for years, a decade even, without ever understanding why you cannot seem to get ahead, no matter how hard you work. So today we are breaking down the loop, piece by piece, starting right now. The first hidden cost is what economists call the poverty premium, and once you see it, you genuinely cannot unsee it. Take car insurance. Simple example, if your credit score is strong, say above 700, you might pay around $100 a month for a solid policy. If your credit score is low or you have gaps in your financial history, that same policy, same car, same driver, same roads, same level of risk could cost you $200 to $250 a month. You are paying double. Not because you drive worse, not because you have more accidents, because a number on a report signals that you are financially stressed, and the system charges you more for that. The same mechanism applies to housing. If you have savings and a strong rental history, a landlord might ask for a small deposit or none at all. If you look risky on paper, they ask for 2 or 3 months of rent up front before you even move in. That is money locked away. Money sitting, doing nothing. Money that could have gone toward starting an emergency fund, or wiping out a small debt, or covering a car repair without needing to borrow. And banking. This one surprises people. Did you know that people who cannot maintain a minimum account balance are often charged monthly fees just to have a bank account? Somewhere between $12 and $25 a month, depending on the institution. That is $150 to $300 per year, just for the right to keep your money somewhere safe. People with savings above the threshold pay absolutely nothing. So the person with more money pays less to store it. The person with less money pays to store what little they have. Do you see the pattern? The less you have, the more it costs you to exist in the financial system. Every single layer of it. So you are already paying more for insurance, more for housing, more for basic banking, and you have not even had an emergency yet. The second hidden cost is where it really starts to compound. It is the emergency trap. Picture this scenario. Your car breaks down on a Tuesday morning. You need $400 to get it fixed. You do not have $400 saved because every month has been tight. So, what are your options? If your credit is good, you could get a personal loan from a bank at maybe 10 to 15% annual interest, pay back slowly over a year. On a $400 loan, that extra cost comes to maybe $30 total. Manageable, barely noticeable, but that option requires a good credit profile, which you may not have if you have been financially stressed for a while. So option 2 enters the picture, a payday loan, a short-term cash advance where you borrow $400 and agree to pay back $460 or even $480 when your next paycheck arrives in 2 weeks. That is an annual percentage rate of somewhere around 400%. Not a typo. 400% annual interest on a loan you took because your car needed fixing. And here is what I really need you to understand. People do not take payday loans because they are irresponsible. They take them because it is the only option available to them at that specific moment, and the system is structured exactly that way. High-risk borrowers, which simply means people with less money, get access to the most expensive forms of borrowing. Low-risk borrowers, which means people who already have money, get access to cheap credit. The people who need help the most get the worst deal, and around the loop it goes. Now take a moment to add this up across a full calendar year. Extra insurance costs, higher housing deposits, monthly banking fees, 1 or 2 emergency borrowing situations. With high interest, you could easily be looking at $2,000 to $4,000 a year in extra costs that a financially stable person simply does not pay. That is money that never builds. That is money that never compounds. That is a hidden tax on being broke that nobody puts on a price tag and nobody explains to you. The third hidden cost is the one that runs deepest. It is the cost inside your own head. And this one matters more than most people realize. When you are in a state of ongoing financial scarcity, your brain is under a kind of constant low-level pressure. Think of it like this. You know how your phone slows down when too many apps are running in the background? That is what financial stress does to your thinking. Part of your mental processing capacity is always occupied, running calculations, managing anxiety, planning for the next shortfall, preparing for the next problem, and that leaves less bandwidth for everything else. Less capacity for long-term planning, less capacity for calm, deliberate decisions, more reactive thinking, more short-term focus, more likelihood of making a choice that brings relief right now but costs you more later. This is not a weakness. This is not a character flaw. This is what sustained financial pressure does to a human brain, and it is why the advice to simply budget better or stop spending on things you do not need is so incomplete on its own. Because you are not making those decisions from a place of calm, clear thinking. You are making them under load. You are making them tired, stressed, and worried. And that context matters enormously. So, what do you actually do? Because knowing all of this is only useful if it points somewhere real. The answer is not to fix everything at once. That thinking is what keeps people overwhelmed and stuck. The goal is to break one link in the chain. Start with a buffer, not a full 6-month emergency fund, not a big savings target that feels impossible from where you are right now, just a buffer, $100 that does not get touched no matter what, then $200, then $300, then $500. Even a small financial cushion fundamentally changes the decisions available to you. It means one small emergency does not automatically become a high-interest loan. It means you have one fewer fire burning in the background of your mind at any given time. The second move is to understand your actual cost of borrowing. Every credit card, every buy now pay later arrangement, every installment plan. Know the real annual percentage rate on all of it. Because the moment you can see the true cost of each option, you can make genuinely different choices. Sometimes borrowing is still necessary, but you make that decision with clear information, not out of pure desperation. The third move is to attack the poverty premium directly. If a higher credit score would lower your insurance costs, reduce your borrowing rates, and eliminate deposit requirements, then building your credit score is one of the highest return investments you can possibly make right now. It does not happen in a week. One on-time payment does not move the number, but 6 months of consistent, responsible credit behavior starts to shift things. A full year of it changes your profile meaningfully, and a changed number changes your access. Different options, lower costs, less drag on your monthly income. Here is what most people never truly understand about building financial stability. The first goal is not to get rich. The first goal is to get stable, because stability is what lowers your costs. Stability is what improves your access to better financial products. Stability is what creates the mental space to actually think forward, to make plans, to build towards something, instead of just managing this week. Every person you have ever seen who seems to have their finances sorted out, they did not get there through one lucky break or one massive income spike. They got there by reducing the drag, by identifying the invisible costs one by one and eliminating them, by building just enough of a cushion that they stop being completely at the mercy of every single unexpected expense. You are not behind because you are bad with money. You are behind because the system genuinely charges more to people who have less. It is real. It is documented. And now that you can see it clearly, you can start making moves that work directly against it. The person who finishes watching this and does nothing is standing in the same spot a year from now. The person who picks one thing today, starts a small buffer, pulls their credit report, cancels one high-fee account, looks up one cheaper alternative, that person has begun to break the loop. And once the loop starts breaking, it tends to keep breaking. Pick one thing, start there, the rest follows. And one last thing before you go. Share this with someone you care about who needs to hear it. Because the hidden cost of being broke is not just financial. It is the weight of not understanding why things feel so hard. Once you see the system clearly, it stops feeling like a personal failure. And that clarity is the beginning of everything. If this video helped you see something differently, hit the like button and subscribe. Every week, we break down the real mechanics of money in a way that actually makes sense for where you are right now, not where someone assumes you should be. Where you actually are, and that is what changes things. See you in the next one.